Good morning, everyone. Welcome to the Daily Edge on the Place Your Trades Network. We are the network that focuses on trading daily options using the CME Group's event contracts to trade indices, energy, metals, and now Bitcoin. Today's broadcast is brought to you by Tradeovate, which has built a custom app that is dedicated to trading the CME Group's event contracts. You can trade them on your own, on the custom app, or using the Dome on the main platform. And I'd love to go to the Place Your Trades Network. Love for you to take a look at what we've got today. I've got the very bright Steve Place with me today. And if you come to the dashboard every day, you... It's making me log in again. Well, here we go. Okay. Nope. I'll do it this way. All right. Sorry about that. Happens once in a while when you shut down your browser. On the Place Your Trades Network, you're going to find a ton of tools. You've got a great update by our very own Shy Girl, and she gives us tremendous information about how to trade with what is happening through the course of the overnight. She talks about a lot of things that help us with directional motion on the day. Reading this today is one of the reasons that I picked the nose at 4,500. Our gap stats tell us how we can trade to the upside where the probability of closing above the open. Now, these get great for us when they get to about 60 with a profit factor of 2, but it occurs for metals, energies, and the indices. Great way to trade those. And my favorite place is the option tools, particularly for where the event contracts are going for the yes, the nose. We can take a look at the snapshots for where prices are headed, equities, metals, energy, FX, crypto. It tells us where things are trading, where people have bought the yeses, those are green, where people have bought the nose, those are red, and then price as it goes forward. Today, I have the great fortune of connecting with a friend of mine that I have not spoken to in probably 8 years. That is Steve Place. And so, Steve, welcome. Good to see you. It's great to see you.
It is, yes.
I did not realize that we lived in such near proximity of each other statewise until I talked to Kunal, and he reminded me, hey, Steve's my neighbor. And then I realized that we're all in the same bit. Of course, you're in the central time zone, right? You are in the Panhandle?
Yeah, I'm in the Redneck Riviera. Yeah.
Hey, listen, the beaches there are so great. They're absolutely gorgeous.
We played hooky a little bit yesterday morning. My wife volunteers at the turtle rescue here, so we got to go release a turtle, which was cool to see. So yeah, it's great out here.
Yeah, it's absolutely beautiful. So what I love to do with my guests is talk to them about their beginning and their rise through the markets. What brought you? I've always known you as an options trader extraordinaire. And so I don't know if you began in the option space, or tell me a little bit about what brought you to options in the first place.
Well, so this is a bit of a complicated story. I'll try and get it fast. I was renting a college house at UCF, and someone's mail came and it said Options Express. I'm like, okay, that's a clue. I was working at a defense contractor. It turns out I'm a terrible employee. So my internship,
I've been called that.
Well. So I basically went to the library and I was teaching myself all this stuff on my own. My degrees in electrical engineering and all of the math there translates to options pricing. It's the same equations. So while I was working at a different defense contractor, being a terrible employee, I started talking about my ideas on this new Web 2.0 application called Twitter. That's how old I am. I started getting interest with that, and then I worked with a company, StockTwits, where they were taking all of the stock tickers that had dollar signs in front of them, aggregating into a central portal, and that's basically how I got my start. So, being a completely reckless 20-year-old, I started a trading service, traded on my own, quit my job at basically at the bottom of the market in '09, and that's how I got my start. So
Wow.
I my original focus was a lot on the options and the complexities and the spreads because of the math and everything, and that was my main kind of trading style, focusing on the complex stuff. Usually net option selling. My trading style has shifted basically since about 2018, where I do embrace convexity a little bit more than I used to on the long side. And so that's where I'm at right now.
Explain to folks what convexity is.
Convexity is it's basically the thing that is currently driving our world, both in terms of markets as well as just culture and economics. Convexity basically means, as if you have a position, let's just say you have 100 shares of a stock. Now imagine as the stock rallied, you automatically were gifted another 50 shares. All right. So that's how options work. That's what a call option does. It increases exposure as price moves. And so that's how you can get asymmetric risk reward. You can do it on the other side too. You can say that a risk event is not, it's overblown, and you can be short convexity. But a lot of people over the past 5 years have been blown out by that. You had the COVID
Right.
crash, you had the GameStop squeezes. So you've got a lot of moving parts in the markets where you're just having these convex events a lot more. I think a lot of that has to do with the push, towards, just what's the best way to put this? We have a lot more derivative driven flows. So I
Yeah.
call it wagging the dog, where if you
Mhm.
get enough options on the wrong side of the trade, the markets start to break. We had Volmageddon in Feb 2018.
Yeah.
We had the tech wreck in 2018. You had COVID. You had the GameStop run on both sides, and so that's just how the market operates now. You just have to embrace that convexity.
Why do you think that that's why do you think that that is? What do you think's happened to the markets themselves that have created
Okay.
um
So I have a really good example outside of the markets.
yep.
Over this past weekend, there was a huge shakeup in college football where a lot of the teams in the Pac-12 just basically yeeted out of there and went to Big 10, Big 12, other conferences.
Yeah,
And
more
within
money.
college football, the way that that market is structured, it's now more efficient and liquid because you have the transfer portal, you have different negotiations that have happened in these conferences, and it has caused a consolidation in power, right?
Right.
The same thing has been going on in the markets for a while now, where you have, because of market cap weighted indices, you have Apple, Amazon, Meta, Google, not Facebook, Meta again. Just the concentration of liquidity has continued to push that way. On the options market, all of the flow is now concentrated into very short-term options.
Right.
And you can try and fight it, or you can just be like, this is the market as it exists. It's time to adapt to that kind of trading.
Yeah. I would say that that is a fantastic example of what's going on in the market. Now, do you find yourself uh gravitating at all to the future space, or do you still like sitting squarely in an options environment, or do you like looking at equities more because of what you see happening in the market?
So when you think about straight equities and futures trading, options traders tend to be a little bit pretentious about this, right? Where we say, oh, there's a lot of option traders that believe you can't make money timing the markets and the only edge you have is in volatility selling or something like that. Very silly idea. But they don't call it trading. They call it Delta One trading, which basically means you have no convexity there at all. It's just a straight stock. So I'm just about to get stopped out in some futures contracts. So we'll see how that goes in the next, I don't know, 30 seconds to 5 minutes. So yes, I am involved in the futures market. It's going terribly right now. No, I mean, look, this is a pretty decent level to work from. There's a really good level just underneath price. So if like the NASDAQ is going to come into a big level that I think you just got to go buy some calls for some kind of a snapback. So yes, I am involved with that. I think if you can be a decent market timer and you can be a decent, if you understand options, okay, those two combined are very powerful, right?
Yeah.
Kunal is now an options trader, but he's also one of the best stock timers I know.
Yeah.
So he doesn't need to know the complex stuff. He can just go buy some calls and say, stock go up, I make money. And I think that a lot of option traders try to overcomplicate the heck out of everything. When just because you don't feel comfortable taking a direction. So you end up with these complex spreads that ideally will make money, but you can get a lot better edge if you just throw a little bias in there and say, oh, I kind of want to be net short right here, or I want to, hedge my longs, even though it's not part of the system, it's purely discretionary. So yeah, that's kind of how I'm thinking about the market right now. There's a million different ways to make money in the options market. There's no perfect way. You don't have to have a dogma associated with it. But having market timing under your belt probably takes precedence over knowing the option Greeks.
Yeah. You know what? You just described my very same journey of trying to always be net neutral and then figuring out that if you just understand a little bit about flow, you can do a lot better if you pick a direction.
I mean, I remember back in the early 2010s, I'm like, oh, I got to make sure my entire portfolio is delta neutral. And that's just a massive drag on your portfolio. Like each position should be a good position to get into. You shouldn't be like, oh, I have to hedge. You're not an institutional vol arbitrage thing. You're some knucklehead retail trader, right? That's not going to be where the edge manifests. It sounds cool, but that's not how it works. So
that's right. That's true. And so that brings me to that big question that you and I talked about last week, this notion of liquidity really affecting the smart way to position yourself in the market, and why it matters more to understand trader placement, as it were. And we're going to really get into that. So the first thing, your liver thanks you for that right there.
This is a health food drink. All right. This is the drink of my people. It's 0 sugar. It has B vitamins and caffeine, which is neuroprotective. All right. I'm tired of people trashing on my monsters. They're perfectly healthy for you, I promise.
All right. So, what was my question?
Liquidity.
Liquidity. Yes. So when we talk about liquidity, just as an individual, that's how much liquid cash do I have that I can get to use at a specific space. And when we talk about liquidity in the market, it's a little bit more dense than that. And so I'd love it if you walked us through this notion of liquidity and why it's important.
Okay. So the two things you just described are the same thing, just on a different time frame.
Okay.
Right. So liquidity is like, how much cash do I have to get out quickly? Right. The market's the same thing. Right now, how much cash is on the sidelines that wants to buy? Right. How much inventory is there that needs to sell? Right.
Okay.
And liquidity on a microstructure level refers to bid-ask spread, how quickly you can get filled, things like that. but it's also cash and inventory. How much is available? And if liquidity runs out, if no one can get filled, price moves. Price has to move. So if you can identify where there in the past has been a lot of liquidity, and that when there's been no liquidity, you've got yourself a very good framework to start from.
All right.
So back when I used to get in a lot more arguments on the internet, finance Twitter still argues about dumb stuff, right? And one of them's like fundamental analysis or technical analysis, and then you got the guys who are, the CFAs versus the CMTs. It's like the Jets and the Sharks, right? So, I mean, on the fundamental side, price to earnings has price embedded, price to sales has price embedded, growth at a reasonable price. So, at its core, fundamentalists are still following price. But then you have the technical analysts that kind of make shit up all the time that say, this line crossover is bullish. Well, why?
Right.
You have to know the underpinnings of
Right.
it. And every good trading system, when you get down to it, has a liquidity framework embedded into it. You may not know it, but like trend following is basically saying the liquidity on the offer will continue to be less than the liquidity on the buy side, right? And price will auction higher. Right, it's the same thing on bear markets and distribution and everything like that.
Absolutely.
You could think about MACDs and RSIs, which are talking about either buyer or seller exhaustion. And when you think about RSI divergence trading, you're basically looking for a failed auction after a pivot higher or lower. It's all there. It's all liquidity. You just need to think of it like that.
All right, so let's actually use some pictures to
Sure.
really, because I love. Sav, if you could put that, yes, thank you so much. This is a daily bid ask for the candlestick of today. And then over on the right is all the volume of that day. Now, if I see something fat like this building, Steve, what should I be thinking in terms of liquidity? What should my mind?
I got to put my lucky glasses on. They actually, I don't know if you can see it. The dog got a hold of it, but I'm too cheap to buy a new set. So when I look really weird. So think about, I don't know if you've ever heard of an iceberg order.
I have, but I'm not sure I could define it.
So an iceberg order is a special kind of order in the market where you flash, let's just say 100 shares to buy, but you've actually got 3,000 shares to buy. And so as that 100 gets filled, it's automatically putting more size there. So oftentimes what you'll see is the market will sell off, right? And then all of a sudden, this volume shows up with a lot of interest involved, and price fails to auction any lower because now there are more buyers and sellers.
Okay.
Right? And I didn't get stopped out yet. So this is working so far.
Good.
So let me take a step back. When we talk about volume, a lot of people, they put traditional volume bars on their chart, and that's volume over time. And that can be kind of useful, right? It shows you how busy a market is, but it doesn't give you the full picture. So instead, you want to look at volume by price instead of time, because then it becomes like a poker table. You've got, beginning investors and traders always think about the cards on the table and the cards in their hand, right? Very talented financial speculators are thinking about the motivations of all the other traders or all the other who owns the cards, right? So if you're gambling in Vegas and this guy has played in the World Series of Poker, you probably want to play differently to him than some drunk who's there at a conference, right? And you can feel those emotions embedded in the price action and how much volume has traded at those prices. So, for example, we talked about this earlier. I don't know if you can, I know it's really hard to see for people because it's a black screen and a dark gray outline.
Yeah, let me see if I can change it.
Composite volume on the right side, if we could make it like a hot pink or something like that.
Let me see if I can do that. Nope.
If it's an individual study or an indicator, you may have to edit it from that.
Yeah, let me see. Volume. Here we go. Color. Hot pink, you say?
Yeah, let her rip.
Hot pink coming right up. Whoops, wrong one.
That's the volume we don't want. You see how there's no signal there? It just tells you the volume that's been trading, right?
Absolutely.
So it's either VRVP or market profile. I don't know.
Yeah, maybe. Let me see. Volume profile. Volume delta. Huh. Delta histogram.
Is there any way you can just zoom in the x-axis so we can just see that without it adjusting?
Yeah, I'll do it.
Right.
I'll do that. Sorry about that. Let's take that out of there. Okay.
Well, we should have done this in prep. So apologies to the viewers out there.
Yeah, that's my bad.
Okay.
So it's a little brighter. That's
a lot easier to see. So you see a lot of volume building out right now. Price is failing to auction lower. There's a couple very high quality levels just underneath, and it's possible that, you know, the lower information traders out there are waiting for that, you know, for the perfect wind up pitch. But there's a decent level here that could be in play. But look at the other level. Look at how much volume built out. And I can't read that number. That's going to be where's the next HVN up there?
This one up here? No, the next.
Let me see if I can full screen this.
4,500. That's the VPOC of this one.
No, the next one was that about 4504, 4505. You see where the volume sticks out the most right there?
Oh, yeah.
So for our viewers watching, I want you to imagine that you are a trader that bought the market right there, and you didn't get stopped out, and you've seen this big push to the downside. Now, I want you to imagine that the market somehow recovers here and rallies up to that level. Now, think about the motivation of that person who owns inventory, right? Where they say, oh my gosh, that was, you know, a 20 or 30 handle drawdown. Thank goodness I can get back at break even. And now you see a motivation to sell from that one trader. Well, if there's a lot of them, and as we can see, there's a lot of inventory there, that's probably a good place for some of the buyers at the bottom to take profits into that and potentially consider a retracement short. Okay. Now that's one way to think about it. But the other thing, and we talked about this earlier, a lot of folks are not comfortable with buying out of the money options, right? They always want to do at the money or in the money because someone told them a long time ago that 80% of options expire worthless, which is the most BS stat on the planet. Okay.
Is that right?
Yeah, I can explain that in a moment. I don't want to go down that rabbit hole yet.
Okay, yeah. All right. We'll do that another time.
But if you know where all the liquidity sits, those levels act as magnets. Right. And you'll see this. Markets like to go through prior inventory from, you know, if you consider a local value area high or low, right? If we're selling off, it will usually go through that prior liquidity, hit a value area low, and then we see if the market can revert after that push. All right. It's not a guarantee, but that's a pretty decent place to look. All right. So that means you can expect higher speed from these liquidity pockets, these high liquidity areas. Hopefully that makes sense. So
by higher speed, you mean how quickly price action moves through the area or to the area? Yes.
Because if we have if that's a different rabbit hole, but basically liquidity and volatility are two they're tied together. They're almost the same thing. So when we think about the VIX, for example, the VIX is not necessarily a measure of vol, it's a measure of liquidity in the market. Okay. If there's zero liquidity, then the markets are moving 7% a day, limit up and limit down. Okay. So when there are spots with low liquidity, like gap fills, you'll see fast moves through gaps because there's no prior market participants that want to buy there. You can actually go and you can look at the topping process in the Russell 2000 in 2021. And then you look at what's below, and it was like a little flagpole with a giant elephant on top, right? And when
Ah,
it tips over the
okay.
flagpole, there's nothing to support. There's no liquidity,
Yep.
so it's just
Straight
going to go
down.
straight through.
Yep.
And that's
Yep.
what happened with the Russell, and a lot of other
So,
markets.
so let me interrupt you for a moment.
Sure.
If I were to look at this and say, all right, I've got, a pocket building here. If I wanted to buy an option, say if let's go to our event contract. If I were looking at this and I said, all right, now before we went live, you said, hey, listen, there's a bottom building here. And so I'm taking a trade because I anticipate that there's an interim floor being set. And you were spot on. Absolutely. And it was because of the building of the volume. At the point that I see this volume building, it would be a fair bet, perhaps, to say, I'm going to say that there's a likelihood that I'm not going to get lower than 44.84. So I would say yes to my 44.80, right? Would that be, at what point of the day would you say, I see enough volume building that I'm going to execute on a trade based on this liquidity event?
Right. And that's a really hard question. Do you
Depends.
want to be the first to the party and collect as much premium as you can, right?
Yeah.
Versus looking for that lift.
Gotcha.
So
that makes good sense.
There is always a trade-off in the options market between risk, reward, and odds.
Yep.
Okay. Where if the options market is underpricing a move, you want to be net long options. If the market is overpricing a move, you want to be net short. Okay. There's some other fancy math that goes into play, but if you are initially fading a move and you want to be a net volatility seller, you usually want to enter the market earlier because you want to have that decay, that time decay in your favor.
Yeah.
Right.
So yeah, absolutely.
If you are looking for the fast move, there is a little bit more massaging to do, and you don't want to be the first one there because you not only have time decay losses, you have charm where you start to lose exposure. And I know I lost everyone there. I literally
love Jem Karzan. So he's
but
really
that's the basic idea, right? So if you're a vol seller, you benefit from sideways price action. And usually into these liquidity areas, price tends to slow down. It tends to get stickier. And so it's a decent idea to start early. Hopefully that makes sense.
Yeah, absolutely. Okay. So if I could recap from that space, since we go long only with these event contracts, and of course we also do the micros, so you can short those as well. Incidentally, there was a huge group of sellers at 44.91.75, and so I don't know if they're going to disappear. Just giving you a heads up there because I saw them this morning.
I see them. I know what you're talking about right now.
So
they're not my friend.
So if we are going long only, then it makes sense to allow this to position itself because we're never really selling vol or selling theta. And so that is a great big takeaway. I love that premise right there. So, man, I could just dig into a ton of things with you from what we're seeing here. But what I'm going to say is I would say the yes at 44.80 looks really good. Well, it's gone up $2 since we saw it. It was $13 when we first talked about it. Now it's 15. Top end is 20. Of course, you can only make 20. If you feel like it's going to get up over that seller at 44.90, you could also pick up that 11.50. But the way we came to that with Steve's help was to notice a collection of volume and a lack of price acceptance below these levels. It just was cut off, and then the traders began to build a position, creating this volume profile event and something that says, hey, everybody's agreeing here, and they're going to agree until they have to move price, because everybody wants to stop agreeing, essentially, because we move from places of acceptance to rejection in the great expanse. So we've got to have you back on to go really deeper into a lot of different things. Your name has aistockbook.com. Tell us a little bit about that. Tell us where we can find you.
How much time do I have?
You can talk as long as you like here.
Okay.
Go ahead.
So first off, I'm just going to DM you on Twitter an image that shows the daily volume profile for the ES futures, and you can see how the liquidity went away and we jammed down into the next liquidity zone. All right. So that's, you can put that in the show notes. So you've got two things that happened besides the alien disclosure, right, in July. The first one, you have LK99, which I don't think it's going to pan out, but it is the potential for a superconductor, which leads to all sorts of stuff like Jetsons level stuff, cold fusion, maglev trains, rail guns into space, all sorts of wild things. Then you have another one in healthcare called AOC 1996, which, and I'm not a biologist, but there's something called something like PCNA or something like that, where it has to do with cell replication. If you can halt that, then cells stop dividing. Now, if you've used that treatment, it kills all the cells.
Cancer.
But they just recently found that the PCNA has a different structure on cancer cells. And so we're looking at the potential for a cure for solid tumor cancers. Now, what do these two have in common? The first is that they were done by teams who had been researching this for 20 years at least. And the second, these are fairly straightforward solutions. The LK99 materials and processing were not wild. Neither is this medical breakthrough. That may pan out, might not. But what I think is happening is you have teams of they have the best domain expertise of anyone on the planet, and they're taking their data sets, putting into artificial intelligence, which has zero biases about research. And then it's like, hey, have you considered this? And they're like, this is kind of obvious. It's been under our noses this whole time. And so we are starting to see potentially second order effects from the artificial intelligence tech that got released over the past 12 years in highly technological domains. And if you want to talk about convexity, right, we're looking at potential step ups where it's the internal combustion engine times the internet times 10 very quickly. All right. A lot of this is not going to be priced into the stock market yet because it's all very new technology.
So these are longer holds.
Yeah. And so I did a write-up on my opinions on AI. I allowed ChatGPT to give its own opinions on AI, and I give my 3 AI stock picks in it. On top of that, we go a little bit further into everything we talked about with respect to liquidity analysis. And there's also a training video that you can watch that goes, if you've never talked about volume by price, which is what we call our trading roadmap on a daily chart, it predicts in advance all of these levels that you can trade off of without any other indicators. A lot of them will line up with them. And so you kind of get a 1-2 punch. But it's a very powerful framework, and it's available to everyone now. Like volume profile and swing anchor VWAPs didn't really exist on retail platforms until 2020 or so. Right. So all of this is available to you now, and you just have to know how to use it.
And you're going to do that for us, aistockbook.com. Is that right?
Yeah.
Awesome. Love it. Yeah. I'm going to go out there and have a look. I'm fascinated by that stuff. Steve, thank you for letting us see just a little bit of that genius brain that you've got in there. I appreciate the time. It was fun. Yeah. It was fun getting together. Next time we do it, we're going to get a song on that guitar. For sure.
Yeah.
Thanks so much, everyone, for joining us today on the Daily Edge on the Place Your Trades Network. And we'll see you soon. Tons of great information here. Thanks again, Steve. And I definitely will be off to the AIstockbook.com.
All right. Thank you. All right.